When we began 2020, who could have imagined that mortgage rates would fall by a third, decreasing from 10% all the way down to 7%? Economists are even predicting further rate cuts this year. While this has been great news for borrowers, it has not been good news for savers. To understand how interest rates work and how to use these rate cuts to our advantage, I'm speaking to Mark Brits, Senior General Manager at the Banking Association of South Africa. Mark, thank you for joining us today and helping us unpack interest rates, because it can be very, very confusing for the average person. And I want to start off with this question of the repo rate versus the prime lending rate. What is the difference and how do they work together?
So the repo rate is the rate at which the banks borrow from the central bank. And the way the system works is that the banks are always short. The Reserve Bank makes sure that every single day the banks don't have enough money and have to borrow from the Reserve Bank. What that means is that's the highest rate that the banks should be paying for deposits to fund the lending activities of the bank. Currently, it's around 3.5%. The repo rate drives the prime rate because in the past, the Reserve Bank decided to link the repo rate to the prime rate at a spread of 3.5 basis points. That means the prime rate is at 7%. So the link between repo and prime is preordained by the central bank, and what they want to achieve is the transmission of monetary policy. If they want to control inflation, they must be able to signal to the banks which way the interest rate is moving so that they can pass that through directly to the customer. And that whole process of being able to change the interest rate within the economy drives the way people behave. And it's critical for them to have that transmission mechanism into the economy. And that's where the prime rate and the repo rate link becomes almost a one-to-one direct transmission. So if inflation is starting to rise, the central bank can step in and reduce the impact of inflation by taking away more of your disposable income.
So the Reserve Bank can use interest rates to dampen inflation, but right now they've been cutting interest rates. So what are they trying to achieve now?
Well, in general terms, the Reserve Bank is trying to stimulate the economy by making borrowing cheaper. And in that way, individuals will be more inclined to take the risk of being an entrepreneur or a businessman and therefore take businesses, create jobs. This is all part of the process of stimulating the economy by reducing interest rates.
When the repo rate is cut, do the banks have to immediately cut the interest rate on all our loans?
Yes, banks must cut interest rates because of the link between the repo and the prime rate, and they do so immediately. It may not reflect like that in your bank statement on the day, but the banks will be able to adjust it for value on that day.
How does your credit agreement affect how your interest rates change on your loan?
The credit agreement that you sign with your bank either provides you for a fixed period of fixed interest rate, or it is variable. The variability of the rate means that you will pay different rates, whether the interest rates go up or down, and that is dependent on your loan agreement. It is fixed for the duration of the contract and at a fixed interest rate. It doesn't change. If interest rates drop, you don't benefit from it. Where you benefit from it is when interest rates rise and you pay the lower amount compared to somebody who's coming in to take a new contract. It's not possible to break the contract simply because there are rules around the way in which contracts like these are put into effect, and it has to be really exceptional circumstances for example, a deposit to be broken that is fixed, or for a loan to be recalled and repositioned into another product. You will pay according to where the Reserve Bank sets the repo rate, which is the purpose of monetary policy, to pass that straight through to you as soon as possible.
Thank you, Mark. And the moral of the story, if you have a lot of debt, this is a great time to make a dent in what you owe.